sort of are on board with this notion that the central banks will be there if this starts to become more dramatic. I guess the question is, where is the Fed's tolerance for pain?
Yeah, and I think you were going through that with Steve, and I think Steve's right. It's a tough question. How do they decipher this data? And I actually think it's going to be really hard to get market reactions and Fed reactions out of the data over the next 2 or 3 or even 4 months of releases. These are going to be very clouded by coronavirus, as well as the other topics that Steve brought up. And it's going to be easy to tell two stories. You're going to have the recession camp very excited about any weakness. You're going to have the sort of write-off camp saying, you know what, just look through to the second half. So it is very much a stalemate kind of situation, which I think plays pretty well for the equity market. I don't think you can get a sort of huge sell-off, and you might just grind it out. And as Sarah opened up the segment, she said, we're only 0.5% from record highs. We're up 4 and change percent for the year. Feels pretty much okay. And even if we get weak data, I think you're just going to have that tussle like I just talked about, right, keeping things reasonably set in the equity markets.
So when it comes to inflationary effects, Powell has said it's got to be significant and persistent, right? They want to see this thing run hot before they change policy to the upside. But it sounds like the tendency to listen to coronavirus, I mean, there's a hair trigger response to the downside. Why is there that asymmetry right now?
I mean, I think more people are focused on demand side issues than supply side issues, which should be negative for the inflation outlook. But we'll see. Most of these things that have disrupted activity, whether it's tariffs or the like, have actually been more disinflationary than inflationary. And if you remember, tariffs were supposed to be inflationary as well. So I think we just want to watch the demand side, especially what's coming out of Asia after all this. And look, there's also a fair amount baked in just in the technicals and seasonals with some of the inflation data that it's probably likely to come out on the softer side and grind a little lower into the next 3 to 6 months. So the Fed actually has a really difficult task ahead in terms of sort of sticking to their playbook and doing nothing if we continue to get that disinflationary pressure. And that may be more of the trigger that gets that July story at 60% more of a reality.
Interesting. You know, we've had this dynamic for a while now. When there's fear in the global markets, everyone rushes to the U.S. But this B of A fund manager survey this morning that Pisani pointed out said the 2020 election is the biggest risk factor to fund managers. What happens to that global U.S. dynamic when we get closer to November?
I mean, it's still far enough away. We have Super Tuesday, which looks like it will be pretty exciting now. We've added Bloomberg to the mix, so that'll be a fun one to watch. I mean, the markets would love a Bloomberg-Trump sort of fight. I think either one would be pretty positive on the market setup going forward. And the market's really just trying to price in the rise of Bernie and how to hedge that. And I think we're still far enough away that they're not going to jump too far or go too far down the rabbit hole into what that means for the outlook for returns on capital, which would obviously not be particularly good in the event that we do go down that path. So I think we're far enough away, and there's too many other things that are going to keep the markets focused on the short term, particularly the virus, the downside from that, and trying to decipher this data.
What do you mean? Why do you say the market would like a Bloomberg-Trump matchup?
Because I kind of think, look, I mean, Bloomberg's they've both been Democrats, they've both been Republicans, they're both pretty market-friendly people. They're not anti-capitalism. The big risk here for the election is that we move on a sharp trajectory to the left where, we sort of push aside some of the sort of capitalist structures that have helped drive returns on capital in the U.S. to be some of the best in the world. We become more European or more Japanese in that setting where we look like we have a more, for lack of a better word, socialist capital structure. And I think the markets are going to key off that. But, whether the reality of the sort of a Trump-Bloomberg fight would be, I think, for Wall Street, it would almost be kind of a non-event. It'd be much more about personalities and much more about foreign policy and much more about how, all of the other personality issues that are driving this election rather than real specific market stories that are going to drive a wedge into the returns on capital that have been driving S&Ps higher now for many, many years.
Well, the trash-talking tweets, for one. David, you mentioned we don't want to become Europe or Japan. Both Europe and Japan had pretty dismal economic data over the weekend, and ZEW out of Germany, the economic sentiment index, very poor overnight. Japan's GDP very poor. Are we underestimating the spillover impact for the global economy that perhaps feels the coronavirus a lot worse than the U.S. does?
I don't know that I think a lot of people are pretty nervous about it, Sarah. I'm pretty nervous about it. It's part of the reason why in our trading structures,
well, I'm looking at the U.S. stock market.
Yeah.
U.S. stock market
Yeah.
and the global growth trade don't appear to be correlated right now.
I guess I would take a slightly different tact with that and say that I think the global stock market is keying off of the idea that if it gets bad, which it might very well do, there's going to be a very severe and aggressive response by the central bank. And I think people have maybe underpriced or underthought through the chess game, which is if we go down a pretty ugly path, we're going to have zero rates and more QE before you can blink. And I think that's more of how the stock market is forward-looking in this. So I don't think the stock market is saying, hey, this is not a big deal. The stock market's saying that monetary policy responses to a very severe outcome could actually nullify some of those effects or reverse some of those negative effects that we're seeing. And maybe the reason that the Europeans and the Japanese markets aren't performing as well is that they don't have the same faith in the central banks that the S&P has faith in vis-a-vis the Fed after the last 10 years. And in Japan's case, the last 30 years of kind of screwing it up.